Hello, welcome back. Today we'll cover the second topic. We'll talk about the ratio analysis. Okay, I will give you the same question. Suppose if you want to know a company, where to start? Okay, you may say, I know this answer, to see the financial statements. That is partially true. We know the financial statements may tell you, how the company looks like, and all these numbers will give you a wonderful idea, how the company are. But the thing is, if you look at these financial statements, there's so many numbers. If you want to get some kind, that the insightful ideas, most of the time you find it is very complicated and you can hardly to get any ideas there. So there's one way is we can do is use the financial ratio analysis. The financial ratio analysis is saying, summarize the company's financial statements in several simple ratios. And all these ratios, everyone in the business areas, they will understand, what's the meanings of these ratios. So the financial analysis, or we call it the ratio analysis, will summarize the company's financial situation. And we'll introduce the financial ratios here. Usually there are 5 categories of the ratios we will talk about. The first category is a liquidity ratio. The liquidity ratio is saying, in the short run, if the company wants to pay their bills, will they have enough, liquid assets or not? So that is liquidity ratio will tell you. First liquidity ratios we call the current ratio. The current ratio is calculated from the current assets divided by the current liability. Remember, the current liability is the amount the company has to pay in the short run. So the current ratio tells you whether the company has enough, that's the liquid assets to cover its short-term liability. So the current ratio. But remember, when you calculate the current ratio, use the current assets. We know current assets have cash or cash equivalents, accounts receivable, and also inventory. Will the inventory can convert into cash easily? Most of the time, the answer may be no. So if you know that answer, then the current ratio may not provide you the accurate information about the company's liquidity. Okay, the inventory is not good, so we take inventory away. So we calculate the quick ratio. The quick ratio is use the current assets, but we deduct the inventory. Then use these numbers divided by the current liability. So here you see from the quick ratio, we are using the cash or cash equivalent and accounts receivable. Use that amount to measure our short-term liability. So here you see the quick ratio will provide more accurate information, whether the company will be able to pay their bills in the short run. So this is for the liquidity ratio. The second ratios that we talk about is the assets management. The assets management ratios tells you how the company uses their assets. Suppose for a company, if it is possible for them to generate the same amount of the sales, will it be a good idea to reduce the inventory levels? Some of you may say yes, because the inventory itself will not generate money for the company. The inventory is put in there just to support the sales, right? If the inventory is too much, actually it will cost the company. Remember, the inventory will not produce additional money. There is opportunity cost there. If you have the cash, you may be able to invest in someplace else. But when you put the cash into the inventory, then you see you have to hold a lot of inventory there. So one way is we can see is how the company to manage their inventory. If they can maintain the same levels of the sales, but they can keep their inventory level as low as possible, to maintain their operating, then that may be a good idea. So that is the assets management ratio is talking about. So first is we have the inventory turnover ratio. The inventory turnover ratio is use the cost of the goods sold divided by the inventory. So this one tells you based on the company's annual sales and the current inventory level. So how many times the company has to replace their inventory. If they replace their inventory frequently, then that indicates they use their assets more efficiently. Because their inventory will stay there just a short while, then quickly they will be sold out. So the company no need have a lot of place to store the inventory. So they no need to keep a lot of the inventory. So that indicates the company use their assets very efficiently. And so the second one we are using is the total assets turnover ratio. The total assets turnover ratio is compare the company's sales value and with the company's total assets value. So use a simple way to explain the total assets turnover ratio. That is saying, for every dollars of the company's assets, then how many dollars these assets can generate the value for sales. So this is for the total assets turnover ratio. If the company use the same amount of the assets, they can generate as high as possible sales, then we say the company use their assets very efficiently. So that is for the assets management ratio. Another group of the ratio we will talk about is the debt management ratio. Remember, in the first topic, we mentioned the balance sheet, right? So the company may need to borrow money to support the company's operations. When they borrow the money, there are certain benefits. One thing is, when you borrow money, the cost of the borrowing is cheaper than the cost of the stock. When you issue the stock, it's very expensive for the company. You have to pay the dividends to the shareholders. Otherwise, the shareholders may not be happy. So use the debt, it will reduce the company's cost of the capital. But when you use more debt, then that will bring in some additional trouble for the company. If you have the debt, then you have to make the periodical the interest payment. When you have the debt outstanding, then the interest payment is your obligation. You have to make that payment. If you fail to do so, then the lenders, or we call them the creditors, they can force the company into bankruptcy to liquidate the company's assets. Even the company may have very good business plans, then they will be able to make a lot of the profits. But if the company cannot maintain, that's enough liquid assets to pay their bills, the company will have trouble. And the first, we talk about the debt ratio. So the debt ratio will tell you, based on the company's assets, how many percent of the assets they are financed by debt. So the debt ratio, higher debt ratio indicates the company borrowed a lot of money. And another one, we use the equity multiplier. The equity multiplier is use the total assets divided by the total equity. We know the total assets is equal to, that's the total equity plus the liabilities, right? So if the company has a small amount of the equity, then that indicates they borrow a lot. So here you see, if the total equity is small, then that will indicate the equity multiplier will be bigger. So here, the debt ratio and the equity multiplier, they are on the same page. If the company has a higher debt ratio, then usually they will have the higher equity multiplier. And the equity multiplier, usually we use this one to represent the company's financial leverage. If the company borrow more, then we say the company is highly financial leveraged. So the company may have the higher financial risk. The financial risk indicates the likelihood whether the creditors may take the company, put the company into bankruptcy. So that is for the debt management ratio. And another question I need to ask you, why people want to set up the company? You may say they just want to make money. So how to measure that part? How to measure the profit? So we have the profitability ratios. In this category, first we talk about the profit margin. The profit margin is used the net income divided by the sales number. So this one tells you, for every $1 of the sales, then how many cents the company is making profit. So that's the profit margins tells you. And the second one is the return on assets. Return on assets tells you, for every dollars of the company's assets, then what's the profit it is generating. And we also have the return on equity. The equity is indicates, for the shareholders' investment in the company. So this one tells you for every dollar's investment, from the shareholders, what's the return they are getting. So the return on equity most of the time is the most important financial ratios, for the shareholders they may pay attention to. So this category tells you the profitability of the company. And later we'll talk about more on the return on equity. And another ratio groups we'll talk about is market value ratio. For the market value ratio is, remember, most of the times when you see the value from the financial statements, that's what we call the book value. The book value indicates, their historic value, and they may not relevant to the market value. The market value, we say, if you put the company assets on the market, then what's the price you can sell? But the book value is totally different. The book value just records, when the company gets the assets, what's the price they paid, and over the times, what's the depreciation they have deducted from that assets. So the book value is just historic information, and they have to follow a lot of the accounting principles. So we might say, these numbers, they are manipulated data. So sometimes they will not reflect the real value of the company. So that's the reason we need to consider the market value. For the market value ratios, first we have the PE ratio. The PE ratio is we call the price and earning ratio. So we use the stock price per share divided by the earning per share. So this one tells you for every $1 earnings in the company, then what's the price you are paying to buy the company stock. So if the PE ratio is higher, then that indicates for every $1 earning in the company, you are actually paying a high price for its stock. So you may say whether the PE ratio should be high or should be low. Usually, the higher PE ratio indicates the company's stock is relatively expensive. And for the lower PE ratio indicates, the company's stock is relatively cheap. But we all know, the price may not guarantee the quality. So we have to read more about the PE ratio before we can decide if, which stock should you buy. And another thing we talk about is market book value. So the market book value is based on the shares outstanding. What the share price is currently is going. So we have the share price. And we also have the book value of the company. So we calculate the number of the shares outstanding, then use the company's book value divided by the number of the shares outstanding. Then we have the book value per share. So this one is usually we indicate for the replacement value. So for this company, if you just want to replace the company's assets, then what's the value you need? And for the market value indicates what's the company's assets currently worth in the marketplace. So this ratio usually should be greater than 1. So that indicates the company itself generated some additional value. When you see the market book ratio is less than 1, then that indicates you no need to buy the companies in the stock because it is undervalued, it is overpriced. You can directly buy the assets similar to assemble a new company. The value will be much higher than that's the company currently. So usually for the market and the book ratio indicates whether the company created values or not. If they are not creating value, then that indicates they are losing value. So no one wants to buy the company, they are losing values. So that is for the market value ratios. And another thing we want to emphasize here is on the return on equity, the ROE. Remember, the original definition for the ROE is use net income divided by the equity. But we can rearrange this formula. So first is we can use the net income divided by sales, multiple sales, then divided by total assets, multiple the total assets, then divided by the equity. So here you see this formula and this formula, they are exactly the same. So this sales can offset the sales, right? So this total assets can offset the total assets. But when we rearrange this formula, actually we can see more ideas than the original return on equity formula. So here, the net income divided by sales, what's that one? That's profit margin. And we have the sales divided by the total assets. This one, that's the total assets turnover ratio. And the total assets divided by the equity. We just mentioned this one is related to debt ratios, right? We call this one is the financial leverage ratios. So this one tells you the company's capital structure. So you may ask, I have rearranged this formula. Then what kind of ideas can you tell me? Well, if you look at the original return on equity formula, you can hardly get any idea. It just tells you, that's the return on the company's equity. But when you rewrite the formula in this way, remember, it will give you some insightful ideas. If you want to increase the return on equity, then how to do it? Remember, for the shareholders, they pay attention to the return on equity. If they can see the company can improve the return on equity, they will be more happy to buy the shares of the company. So the managers always want to make their shareholders happy. So they want to increase the return on equity. So this rewrite formula will tell you, if the manager wants to increase the return on equity, there are three possible ways they can do. First, increase the profit margin. Remember, the profit margin is every dollar of sales, what's the profit the company can generate. Usually it indicates whether the company has a good products or not. If the company has the creative products, they have the market power, so they can charge the higher price. So they will be able to have the high profit. So that's the first part, have the creative products, and they will be able to increase their, that's the profit margin. That's the first way to increase their return on equity. The second way is use their assets more efficiently. If they cannot increase their sales, but if they can use their assets more efficiently, if they can reduce their inventory level, then that will make their assets, turnover ratio higher. So that will also make them, they will be able to increase their return on equity. The last one is, I have done everything. I have improved my products, and I want to come up with a creative products. I have done that part. And I use my assets very efficiently. What else can I do? Okay, the same thing as, the capital structure. Suppose you have a pie. If you have to share with 10 people, then everyone can only get the 1/10 piece of the pizza, right? If you say, how about we kick out some people out of this group? Say, we only have the 5 people to share for the same pie, then everyone will have a big size of the pie. So that's the same ideas here. So if we can improve the financial leverage of the company, so we reduce some of the shareholders. So if we have a smaller number of the shareholders to share the profit of the company, then that will also increase the return on equity. So this return, that's the return on equity formula, tells you if the managers want to improve the return on equity, they have the 3 possible ways to do. Have some kind of creative products, or reduce their cost to improve their profitability, or they can say, use the assets more efficiently. And the last one is maybe they can consider to change their capital structure, repurchase their stock back and have the more debt. So that will reduce the number of the shareholders who will share the profit. So that will make the return on equity higher. So that is for the financial ratios we talked about here. Then the next question is, how can I use these financial ratios? I may say, okay, financial ratios almost make nothing. Financial ratios themselves, they tell you nothing about the company. Then you may get a surprise with this one. Remember, use the ratios themselves, it doesn't make any sense. The ratios has to be compared. So there are three possible ways we can compare the ratios. One way is compare these ratios with industry average to see the company's performance, whether they are above the industry average or below the industry average. That is one way you can use the financial ratios. Another way is compare with the peers in the same industry. And this process usually we call the benchmarking. So you choose some company of interest, compare with the company's financial ratios. So that will tell you, compare with peer companies, how the company's performance. And the last one is trend analysis. Compare these ratios with the company itself. Say, 1 year ago, how about this company's these financial ratios? 2 years ago, to see how the trend, whether the company is improving or everything is getting worse. So that is how to use the financial ratios. But I still need to give you some kind, that's the reminder. When you use the financial ratios, you have to be very cautiously. Remember, the first thing is, for the financial ratios, if the company has the multiple divisions, so you can hardly to find the company, if you only use the industry, so the company may have the products in several industries. So you can hardly to use that way to compare the company's financial ratios. And the second is, remember, all these financial data, they have to follow the accounting procedures and accounting rules. So they may not be the original numbers. So they are manipulated data. So when you use these financial ratios, you have to be very careful. And another one is you have to consider the inflation issues. Remember, all these data, they are recorded from different years. So the price level has been changed. So the inflation may not be reflected in these financial data. And that's the part for the financial ratio analysis. And the next time we'll talk about the times value of money, and I will also show you how to use the financial calculator. That's all for today.